Good afternoon. Welcome to December. Welcome to Cup of Joe. I am Mike Carrazzo, your host. I am content manager here at Ryerson, and I can't believe it's the end of the year already. Nick and I were talking about everything we've kind of gone over in the past year, and a lot of key trends, a lot of key things we've talked about. But you know, I don't want to delay things any further because I know what everybody's waiting for. Nick, how are you doing?
You know, Mike, I've been better. I think I'm still suffering a little bit of a hangover from the rough game this weekend. Mentally preparing to part ways with the locks that have been growing for the better part of a year at this point. But it's time. It is time. They got to go. Yeah,
for those of you who have been with us the whole ride, those that just joined us, Nick made a bet, a hair wager, maybe about 6 months ago. No, probably not that long, right? 4 months ago, right before the college football season. He would grow out his hair, and he would only cut it if one of two things happened. A recession was officially declared, or the Ohio State Buckeyes lost a football game. And I'll tell you, a recession was not officially declared. So,
which I'm blown away about. I actually thought when I made the bet that we were already in a recession. I thought I was just ahead of the curve, and here we are several months later, and it was the Buckeyes that did it to me. So, alas, we are going to shave my head today.
You got right on. Yes.
I'm just playing. We don't have time to shave all these locks today, but I am going to welcome my beautiful assistant and stylist here today to do a symbolic cut of the hair. And for those who care, later this afternoon, evening, I will be getting the official haircut. So the next time you see me, this will be pretty much all gone, and I'll look like a totally different human being. So without further ado, Kirsta, go ahead and do the honors. Show them what you got.
Wow. We'll send a strand to some lucky Cup of Joe listeners.
Well, so Mike, I don't know if you knew this, but there's actually an outside chance that if Utah wins tomorrow and if Kansas State wins, there's a chance that Ohio State could get into the college football playoff still. If that were to occur, and if all the stars align, maybe we get a rematch with Michigan, and I'll duct tape that hair back onto my head.
Perfect. You had to make a new wager at that point.
Exactly.
Well, there you go, Cup of Joe audience. I think you stuck with us for this, so they deserve this payoff.
Absolutely. So without further ado, I think we're ready to hop into the slides and get to the actual meat of the story. Without further ado, we gotta talk about the safe harbor provision to cover our legal disclaimers. These are the opinions of Nick Webb, Mike Carrazzo. This is not investment advice. We're giving the best information we can come across, and we have come across. Do your own research, but you know, if you have any suggestions on ways that we can tweak the information we're providing, certainly let us know, and we're happy to make those adjustments. But let's go ahead and hop into it, Mike. Before we get into that, I know we got a couple housekeeping items.
Yeah. So right here, Engage 2023. Little known fact: Cup of Joe actually spawned off of our Engage conference 2 years ago. Was our first virtual conference. And Nick, you gave a commodities update there, and it rated really high, so that we decided to spin that off in the Cup of Joe. So that is kind of the origin story of Cup of Joe, brainchild of Jason Pounders, our marketing manager. Tip of the cap there. And this year, save the date, January 26th, we're going to be doing our third annual. It's going to run from 10 a.m. to 1 p.m. Central Standard Time. Our speaker lineup's going to be, you know, we're going to have an economist from ITR, as well as we're going to do a live Cup of Joe. We're going to do this as part of Engage with some product managers for carbon, stainless, and aluminum. We'll answer your questions live. We'll also have some special guests. So just save the dates. Registration should be open fairly soon for those of you who want to take a sneak peek. If you go to engage, that's engauge.tv, registration will be open soon.
So that being said, as Mike had said, you know, what we ultimately want to do today, because as we sit here on December 1st, we've covered a lot of ground with regards to metal market themes, broader commodity themes, macroeconomic themes, and we want to circle back on a couple of those and maybe see, you know, which ones really hit, which ones do we miss on, and ultimately to shape that around where we see us going into 2023, how we see the landscape shaping up. But before we do, I think we have to get a little commentary from another gentleman with great hair, just wonderful hair. And I think you'll find a little bit of this theme of the revenge of the old economy really exemplified within this commercial. Many of you have probably already seen it. We'll go ahead and hop into it real quick.
Space, the boundary of human achievement, the new frontier. It's not time to escape. It's time to engage. It's time to plant more trees. It's time to build more trust. Time to make more space for all of us. So while the others look to the metaverse and Mars, let's stay here and restore ours. Yeah, it's time to blaze our trail. Because the new frontier, it ain't rocket science. It's right here.
I think it's a really great commercial because in my opinion, it really sums up kind of what we've seen over the last year to 2 years through all the COVID issues, the supply chain bottlenecks. It's been kind of staggering how we've gotten into, or we did get into a situation for a period of time where, you would have non-fungible tokens trading for millions of dollars. You would have, digital images of apes selling for $2 million, but yet you go to your local grocery store and you can't find a can of soup. It was a very weird phenomenon where, we had kind of shifted into this futuristic world, and yet we weren't getting the basic structures of our economy and society right. And I think this theme harkens back to the metals industry. I think it obviously comes back to this, this commercial in a broader sense, but I think it sums it up in a very strong way. And we've got a couple charts that I think exemplify this. A few of these, if you followed Cup of Joe's in prior months, you will have seen, but ultimately, it kind of looks like we're almost in a part two of sort of a dot-com bust, the dot-com boom and then bust rather. What we're looking at here, and we have looked at this in the past, is the ARC Innovation ETF, which is a relatively recent ETF that's compiled by Kathy Wood is the fund manager's name. And she's taken a lot of risk in investing in kind of startup related technology companies. The good news is when things are going well, when interest rates are low and you've got a booming economy, riskier things like that tend to do extremely well. And you can see that here in the white line. Since 2018, their fund was up 400%. Well, fast forward to where we are today, you can see what's transpired. A lot of these riskier, less profitable tech names have really come back down to earth in a very swift way. And if we overlay that against the NASDAQ composite from 1997 to 2002, which was basically what I'm saying is a comparable time period for the dot-com boom and bust, when you had companies like, they slap an internet name on their company and they go to $1 billion. I feel like we saw a similar phenomenon sort of taking place over the last couple of years as money was very cheap and we had a very strong economy. What's amazing to me, and I think this is a psychology or sociology experiment just depicted in a chart. These are overlaid against one another in percentage terms. And what's staggering is the correlation. You can just see it visually, how it runs up and then it comes back down, then it comes back up and then it plateaus and then gets slammed down. It's almost like human nature just continues to repeat in some semblance over periods of time. And I think this chart kind of shows that. But ultimately, as we think about, the revenge of the old economy, part of that function is really a depletion of this new economy, if you will. And similarly, looking at it in a different way, this sort of mean reversion of the new economy versus the old economy. We talked about the tortoise and the hare earlier this year. I think it was probably March or April of this year. And we compared the idea that, you've got Kathy Wood and the ARC Innovation ETF, which is a bunch of high-flying, riskier tech stocks shown in the white line here. And then you've got Berkshire Hathaway. Berkshire Hathaway run by Warren Buffett. He's, 90 years old now. the bulk of his portfolio companies are things like Coca-Cola and Wells Fargo and Geico Insurance, more old school type industries versus the ARK Innovation ETF. And you can see that for several years since inception, the ARK Innovation ETF just destroyed most other asset classes. Its performance was up, almost 800% at one point in time in 2021. Well, fast forward to where we are here, just like the story of the tortoise and the hare, Warren Buffett's Berkshire Hathaway is now outperforming ARK Innovation. So again, this is just a slightly different way of looking at this idea that value old school economies, they are coming back on a relative basis to some of these high flying tech themes like cryptocurrencies, NFTs, things like that.
Nick, do you equate some of the kind of the turbulence in the crypto market lately kind of contributing to this trend too? It seems like, I guess even beyond that, if you look into 2020, right, the ARK fund's so high because of COVID, right, lockdowns, a lot of people using tools like Zoom and things like that. But and then as we kind of start coming back, and now we're kind of getting what's going on with crypto.
Yeah, I don't want to be too cynical, and I certainly don't want to suggest that some of these themes aren't going to be prevalent 5, 10 years, 20 years down the line. But it feels like we are in a cycle where the tide is going out. And what I mean by that is interest rates are going up, money's getting a little more expensive. The idea of stimulation via checks going into individuals' pockets are behind us, it seems. And there's a fairly famous investing phrase where they say, when the tide goes out, you find out who's not wearing any pants. And it feels like we're in that sort of phase right now, where as the tide is going out, money's getting a little cheaper. People are starting to do a little bit more due diligence around some of these riskier assets. And we're finding out that some of them, not all of them, but certainly some of them are not what they seemed. And in some cases, maybe even worse than that. Maybe some cases they're fraudulent and maybe non-existent. So I think in some asset classes, we are seeing a bit of that. And we probably see that within some companies as well, not just cryptocurrencies. Companies that were kind of living by the skin of their teeth for the last several years, but low interest rates allowed them to survive. PPP money allowed them to survive. And it's seeming like those things are starting to run their course.
Makes sense. Yep.
Switching over to the theme of energy, we've absolutely beaten this one to a pulp over the course of the year, but it continues to be a hurdle for us, not just within North America, but globally. Most poignantly, I would say this issue is going to be felt within the European region. But what we're looking at here is the Strategic Petroleum Reserve, which is a reserve of energy stockpiles, mostly crude oil, that is basically was put in place to build up a reserve of energy such that, if we had some sort of natural disaster or a war, that we could access those reserves. Well, we've certainly accessed those reserves, as you can see here, the steepest decline in the Strategic Petroleum Reserve that we've ever seen. And yet we do have conflict and a war going on within Russia and Ukraine, certainly not taking place within North America per se, but we are draining this petroleum reserve in a way to better supply the market to keep prices from going rampant. So up to this point, we've taken about 300 million barrels out of the reserve, and yet oil prices are still sitting right around $82 per barrel. Still got some issues within Europe that we've got to get through, and we'll probably rear their ugly head this winter. And when we look at Europe specifically, this is looking at switching from oil to natural gas. What we're looking at here is going to be the white line, which is European natural gas relative to U.S. natural gas. U.S. natural gas is currently sitting at $6.89. Admittedly, that's a pretty elevated number relative to what we've seen over the last decade, but it pales in comparison to what we're seeing within natural gas prices in Europe, where prices are about 7 times higher than where we are today. And that's even after they've come off pretty substantially with warmer weather in the fall and early months of winter. So unfortunately, until or unless, and this is my opinion, until or unless there's a real, investment push from the production side of the economy, these issues probably persist until or unless you get a really, really big slowdown in the economy. We may be heading that way, but we're not there quite yet at this stage. So for now, we're still seeing very elevated energy prices, most particularly within Europe. Another theme we absolutely have to touch on is the one of inflation. You can't get out of bed these days without realizing that the price of most things is substantially higher than it had been. One exception to that ultimately is, some of the metals that we deal in. Steel is down 50, 60% from its highs. Aluminum down 40% from its highs. Nickel off its highs by probably 30 or 40%, given today's prices. But when you look more broadly at things like wages, you look at rents, you look at houses, or you go into a bar and try and buy a beer, you'll find that things are significantly more expensive than they would have been 2-3 years ago. This is a little longer term chart than what we've typically looked at, but I think it gives a good perspective of just how out of control inflation got and how big of an issue it is that the Fed needs to get this back under control, and really central banks around the world. What we're looking at in this chart is going to be the PPI in the blue line, which is the producer price index, kind of more of a wholesale type inflation gauge. You've got CPI, which is the consumer price index, and that one does include energy and food. And then you've got the PCE, which is the personal consumption expenditure, coming in at 5.14%. But when you look at each one of these indicators over the longer term period, we haven't seen this type of inflation since at least the early 80s or mid 70s, when inflation was very rampant. And then you kind of had to have Paul Volcker come in, raise interest rates very rapidly, and kind of squash the economy. Not really a fun thing to go through. We may perhaps be in the midst of something like that right now. And on that note, what we're looking at here is really the reaction to what we just saw on the inflation side. The central banks globally are doing the best they can to, and they admit this, to try and cool off the economy and destroy demand to the extent they can. So if you've got energy issues, they want people to consume less energy. They want people to consume less product to kind of rein in the price inflation that we're seeing. What we're looking at here in this slide is the white line, which is the 2-year treasury yield. So basically that's kind of the market's best guess of where interest rates will be in 2 years. And then you've got the Fed funds target interest rate. So this is the interest rate that the Federal Reserve and Jay Powell sets. Well, Jay Powell spoke yesterday, and we're sitting right now at 4%. So Jay Powell spoke yesterday, and the markets got very excited by a comment that he said, which was, it looks as though we are going to slow the pace at which we are raising interest rates. Because over the last couple meetings, they've raised interest rates by 75 basis points in each of those meetings, which is a pretty aggressive move to take. So the expectation is they're going to begin ratcheting down that pace. So maybe next month we see, or later this month, we see a 50 basis points interest rate hike. Now, for those who are curious, one might say, well, if they raise interest rates by 50 basis points, that's going to take the current interest rate above the 2-year rate. How would that make sense? Well, unfortunately, if we're reading the tea leaves, what that might ultimately mean, if they raise interest rates later this month up to 4.5, and perhaps maybe even they raise them again another 25 or 50 basis points after that, we could see, nearby interest rates, basically current interest rates, going to 4.5 to 5%, and yet the 2-year treasury yield is actually below it. Now, how would that be? Well, that's basically the market saying they think at some point the market could get so soft, we could get a recession, and the Fed will actually be forced to not only slow rate hikes, but actually do rate decreases. So we could see ourselves in the next year or two going back in that cycle of the Fed easing conditions because things soften too far. So this is the balancing act that central banks worldwide are trying to deal with, which is cooling off the economy, but not cooling it off so much that you send us into a tailspin type recession. So it's a tricky one. It's going to be a tough task. It's continued to be a tough task up to this point, but the market is basically saying, I would argue that the market is basically saying the Fed's already gone far enough and that things are already softening enough to cool things off.
Hey, Nick, a quick question. In the inflationary environment, if you will, how come commodities aren't inflated?
Well, if you go back on a more historical time period, I would make the argument that most commodities are. If you consider, like I said, natural gas right around $7 an MMBTU, that's high relative to history. It's off its highs over the last couple months. Crude oil at $82, that's elevated, but it's not, it's so far off, the 125 that we recently had. I'd make the same argument in steel where, it feels like, and we'll get into steel in more detail here in a few slides, steel may be troughing right now. We may be hitting a trough at 625, 650 bucks.
Yep.
Historically, that used to be a high. So, so if we look in the context of the last 12 months, yeah, things got crazy. Things got very, very out of hand. And relative to that, we're off substantially. If we look on a longer term basis, the price of all things generally has elevated a bit. And that's true of aluminum and nickel as well.
Sure.
So as the Fed is hiking interest rates, as they're making very concerted efforts to try and cool the economy, the unfortunate thing is sometimes they actually succeed. And I would say that we are entering the space now where things are starting to get a little tepid. And what I want to point out are a couple key things. The first one is the glaring one, that the United States has now gone into contractionary territory. This particular data is looking at the PMI data from Market. Market is the data source. The reason why I want to point that out is because that is different from the ISM. So Market has the most recent data point at 47.7, which is a really big drop off of 50.4. That one kind of spooked me a little bit. So I wanted to look at ISM as well. If we look at ISM, which came out this morning, it actually missed expectations as well. It's not quite as low as the Market data point, but it came in at 49. So both of those kind of confirm the idea that it does appear as though we're not just seeing slowing growth anymore. We're actually seeing declines in manufacturing activity. So that's the first the first point that I want to draw everybody's attention to. Secondarily, when you look on a more global basis, this theme is not unique just to the United States. We're seeing this on a global basis where manufacturing is slowing, either it's slowing growth or it's actually slowing on an absolute basis, with the exception of two countries. India continues to be extremely strong and continues to tick along at a very, very rapid pace. We've talked about that in prior Cup of Joes. The other one, which is, I don't know whether I want to call it a head scratcher, an unfortunate situation, I don't know what I want to call it, but Russia. Russia came in at 53.2 and is actually sitting in green territory per this chart. Now, many of you are probably wondering, how in the heck is that even possible? Well, from what I understand, on December 5th, that is the date in which the EU is expected to put in place its oil embargo on Russian oil. And so that date's coming up in four days. So it's coming up on us very fast. Prior to that, from what I understand, Russia has been very active in getting as much product out the door as they can to really pump up their revenue stream. And if we're using the ISM or the PMI data as a proxy, it looks like they may have perhaps been successful with that. I think the question is going to be if and when that embargo goes into place and Europe is no longer buying Russian product, or instead if they're buying Russian product under what they're calling a Russian price cap, which I admit I don't have full clarity on how that's going to work. The goal is to ultimately reduce the revenue streams into Russia. We'll have to see in subsequent months of data whether or not that's actually proving fruitful. But the theme really on the macro side of things, both within North America and with most regions of the world, is a slowing manufacturing economy, and in some cases even negative growth.
Hey, Nick, with the ISM versus the Market, I'm glad you brought that up, right? Because we usually use the ISM data a lot. And is it usually that different from one another? And like, is there one that's usually more, we'll call it, trusted than the other?
No, I tend to like, for US specific data, I tend to like ISM. It tends to be the more important one. It tends to be the one that has a lot of different indicators or what I'll call sub-indicators below it, where they go into prices, they go into backlogs, they go into inventories. I like it because it seems to be more robust than what Market is doing. The reason why I tend to use Market within this slide is because it gives more of a global perspective.
Sure.
ISM, unfortunately, is not doing this for every region of the world.
Yeah.
So I think this gives a more global picture of things. With that said, we will be looking here in a couple slides. We'll be looking at a different region of PMI data that is actually telling a slightly different story, and unfortunately, it's more to the negative side. So we'll touch on that here in a sec. But kind of rolling with this idea of a slowing economy, the leading economic indicator indexes are really corroborating this data as well. And unfortunately, the next couple slides, you'll see this too. The leading economic indicator index it takes 10 indicators, both manufacturing and non-manufacturing. It's serving a very similar purpose to what the PMI data does. It's trying to identify inflections of cycles. And if we look at this chart right now, both the annualized data, the year over year shown in white, and the trailing 6-month annualized data shown in the blue, both of them are suggesting that we are, I would say with pretty high certainty, heading into a slowing economy as we sit here today within North America. Similarly, this is a slightly different way to look at it, but I think we've talked about this in prior Cup of Joes. One other proxy or leading indicator for recession is the yield curve inversion. And the yield curve inversion is a fancy way of saying when the 10-year treasury yield goes below the 2-year treasury, that can often be a precursor to recessions. So what we're looking at here is the blue line, which is showing the relative value of the 10-year treasury yield relative to the 2-year. So if it's below 0, then that means the 10-year is actually below the 2-year. And when that happens, it tends to lead recessions, which are shown in the red line. The one exception to that was back during the dot-com bust. So who knows? Maybe if we're in a dot-com bust part 2, maybe we don't ever see an official recession. And had the Buckeyes not lost, my hair would have grown down to my feet. But that being said, the yield curve does certainly portend this notion that things are slowing down rather rapidly. So as we sit here right now, I believe it's sitting right about negative 72 basis points of inversion within that. So just one more way to look at kind of the same thing, which is the market is suggesting a slowdown. And I talked about this just a minute ago, but this is looking at PMI data, but not for various regions of the world. This one's actually looking at a specific region of the United States, which is Chicago. And I don't normally give too much credence to the Chicago PMI just because it's kind of nichey. It's very focused on just the central part of the United States. But somebody pointed out something very interesting, which was given where the current PMI is for the Chicago PMI and looking over various points in history where we've been in this type of territory, because we're at 37.2, which is very negative territory. It missed expectations by about 10 points, which is a massive miss. This came out yesterday, and what was pointed out was every other time that the Chicago PMI has gotten down to this low, it not just precludes a recession, it actually coincides with a recession. You can see that going back all the way back over, let's say, 50, 60 years. So unfortunately, and I already got called Dr. Doom earlier this morning when I was on a call with some colleagues, but it does, I would say it looks pretty highly evident that market conditions within North America are slowing, and they're slowing rather rapidly in some parts of the economy. And I do think that that's why Jay Powell yesterday, when he stepped up to the podium, I think that's why he said very directly, we are going to start slowing the pace of our interest rates, because again, they're trying to toe the line of saying, let's cool things off, but let's not cause a recession that's so deep that we all suffer, badly from that.
Nick, is there anything in this PMI, Chicago PMI, that is indicator of recessionary? Like you use this as kind of an indicator. Is there anything within this PMI that's being tracked that would kind of sway that?
I don't have the inner workings of the survey or how they conduct it, where it might be different than the more broad national piece. Mm-hmm. But I suppose you got to if you were to peel back the onion and say what types of businesses exist within Chicago or what types of businesses exist in this general Midwestern part of the country, that would be the group of people who's being surveyed in this exact survey. So, I would say that's going to be heavy manufacturing type companies.
Old
they
economy.
Seem to be, old economy type things seem to be slowing a bit.
Makes sense.
Now, one of the biggest offsets to this notion that we're heading into recession is this chart here, which is the JOLTS job openings data. Again, I pulled this out to a longer time frame because I think it gives perspective of just how robust the job opening market is currently. Now, this can change. There can be layoffs. There can be people canceling their job openings. But for now, even though job openings have depleted down to 10.3 million jobs from 12 million jobs, we are still so elevated relative to history, it's not even funny. And this is why a lot of economists are looking at this and saying, we still need, or we still have room to cool off the economy because there are so many jobs that are still being posted for work that's available. So I know we've talked about this in prior couple of Joes, but there is this potential idea that as layoffs happen in places like Silicon Valley, at startups, maybe those new economy type names, it would be nice. It could be a potential that maybe if they shifted their focus more into some of these older economy type spots, the jobs may be more prevalent. But I think this is one that ultimately has kind of gotten economists scratching their heads because the jobs market is still very robust relative to history. And then the other aspect, so I've talked a lot about negativity within really the Western economy, I'd say Europe and North America. And it does look like both markets are experiencing a pretty significant slowdown. If we look at prices of metals and commodities over the last couple of days, however, they aren't really paying attention to what's going on within the macro environment of the Western economies. And why is that? Well, it looks as though they're taking their cues from some of the rhetoric that's coming out of China. And I know this is one that I will absolutely throw myself under the bus on, having been wrong or premature on, which is I would have thought China was going to reopen months ago, and they didn't. And they continue to come in fits and starts, and they'll try and reopen, and they'll get a big case growth. Well, we're in a situation right now where cases on a daily basis, as you can see on the left-hand side, cases on a daily basis are growing rapidly. But at the same time, what's interesting and different from what we've seen over the last 2.5 years is we're beginning to see some China media outlets suggest that they're going to roll back some restrictions. They're not going to go straight off zero COVID policy to full on, get back to work, travel, do all these things. But they're making small symbolic steps, it seems, where they're taking a quarantine measure from 10 days to 8 days, or 6 days to 5 days, and they're allowing people to go back to work a certain number of days. And although they may not seem like big moves, keep in mind these things are happening right now in the face of what we're seeing. We're seeing rapid case growth. So it's definitely a step in a different direction than what we've seen. And a lot of traders right now are viewing that pretty optimistically. And you'll see that here in a couple charts for the base metals markets, where even as I mentioned, even though we're seeing the macro environment slowing down, many parts of the economy are kind of towing the line of a recession. The idea that China may be coming back to the market and getting back to being a more mobile economy is almost not just offsetting, but maybe even more than offsetting some of that weakness that's happening in the Western hemisphere. So pretty interesting stuff, but there's a very massive cross current that's happening between those two economies right now. So
Hey,
with
Nick,
that,
sorry, I'm going to pause you before you head over to the metals. Now, having heard the macro update, we're gonna ask for some participation from the audience here. We're gonna put up a poll. We want to know how you're feeling about 2023, knowing all this, right? Are you optimistic, somewhat optimistic, confident? I should say confident, very confident, somewhat confident, or not confident, just about in general. So we'll, if you can, there's a poll button at the bottom of your screen there, right next to Q&A. Please submit your answer, and at the end, we're going to reveal what this Cup of Joe audience is feeling about 2023.
and do not let me influence with my Dr. Doom commentary. But yeah, that's how I'm seeing it at the moment. Anyways, let's hop into the metals, which I would say are telling a slightly different story from what we just talked about. So I don't want it to be all doom and gloom. Because certainly on the pricing side, it seems like in a lot of markets, we're actually seeing a little bit of troughing taking place. So let's hop into it. I am somewhat frozen. Let's see here. Okay, there we go. So on the aluminum front to begin, we are looking at a 1-year chart here for LME aluminum. And you can see that over the last couple months, basically since the lows of late September, early October, it may not look like a whole lot, but already we've seen prices rebound by about 20%. Some of that is for reasons that we've discussed in the past, which is a lot of smelters have become unprofitable at those types of price levels. Many of them have had to curtail production. When they do that, it better balances supply-demand conditions. If we look at a couple different indicators, We've got the moving average lines, which again is a gauge of momentum. The 50-day is shown in the kind of pink color. The 100-day moving average is the green. 200-day moving average is yellow. Right now, we're trading above the 50-day and the 100-day, which is a sign that momentum is actually coming back a little bit into the aluminum market. And I would say we're seeing something very similar within the nickel market right now. And a lot of that, like I said, is centering around optimism that perhaps, even though the Western economy is slowing down, China may be coming back to market. And again, as a reminder, and I often forget this, China represents 50 to 60% of global metals demand. So when they come back, they're the elephant in the room, and there's going to be a lot of speculation and positioning around that potential. If it turns out that leaders of China come out and say, no way, we can't reopen yet, this is we're going to do this for another year, I would say almost without a doubt you would see metals markets go the opposite direction and retreat back lower. That's not the current sentiment, but again, this can turn on a dime with one headline from a Chinese official. We talked a little bit about the fact in prior months about the notion that cost curves, the idea that prices can get so low that the marginal cost of production is breached. And when that happens, you have smelters that basically have to say, do we want to continue producing aluminum if we're doing so at a loss for every pound that we're pumping out the door? And we're in a situation right now where almost half of the smelters globally are underwater, and that's even with the price rally that we've seen over the last couple months. So this continues to be an issue, and I would say probably will continue to act as a bit of price support if we were to see prices retreat back lower, because energy prices remain high, cost of labor remains high, and so the cost of making aluminum is also still fairly elevated. One thing that's also changing tune a little bit, for the better part of, I'd say, 9 months, we've seen Midwest premiums decline, and a lot of that's been centered around the idea that logistical networks, freight markets have improved and they've loosened up. And with that, we saw premiums drop from about 40 cents to where we are today, right around 20 cents per pound. Well, for the last several days and maybe even weeks, it may not look like a whole lot, but we have started to, I'd say, get a little more stability within prices, kind of in the mid 19 cent to 20 cent range. I'm not here to call a bottom, but it does look as though prices are finding a little bit of stability. Certainly the declines are slowing. So that's an interesting one as well that's kind of corroborated with the LME aluminum market. Moving over to the steel side, really much of the same here, although again, the declines are slower than what we've seen over the past. Markets have continued to move lower, whether we're looking at North America in the white line, Europe in the blue line, or China in the orange line. That being said, there has been a heavy amount of price convergence between the three regions. When that happens, you often would expect to see imports decline, and we are certainly seeing that. If we went back to March of this year, flat rolled steel imports were annualized running right around 14 million tons. If we fast forward to now, I would say that number is going to be closer to about 8.5 million tons. So certainly imports of foreign material coming into the United States has come down, and that's largely because the gap and the arbitrage from foreign markets to our market has really closed up. There's also the element of, similar to aluminum, there is a point at which you can get so low with prices that it becomes somewhat economic for steel mills to continue to produce. And if we use busheling scrap as a proxy, which we've done in prior Cup of Joes as well, and we take busheling scrap and we add on some arbitrary number of 300, which maybe represents their cost of labor, their cost of energy, their cost of processing, and their own margin, it would suggest that U.S. steel futures are actually somewhat in value territory. Again, this is not investment advice. I'm not saying go out and buy steel futures, but it certainly looks at, if we use that as a proxy, steel mill margins are getting tighter given where we are on a pricing standpoint. And one other piece of evidence I would have that would support that would be this chart, which is capacity utilization. Again, that's the percentage of available production capacity that is actually producing. It peaked out, I'd say, mid-summer of 2021, and ever since then, it was gradually declining. And then for the last 3 or 4 months, it has been rapidly declining. And we're back down to levels that we really didn't see since, well, prior to the COVID lockdowns, didn't really see since like 2018, 2017. So we're right around 72.5, 73% of production capacity that's operating. And that's what happens when prices get so low. The response that the mills will take is they'll say, we'll make less of it. And because we're not doing so as profitably as we used to be able to. Now, I know some of our customers on the call are probably saying, well, cry me a river. You guys had a phenomenal 2 years. So what? Well, the so what is, I mean, these are free markets. They're allowed to balance that production versus profit equation the way they want. And they are certainly attempting to do that as we sit here this week. And it's worth noting that, despite the fact that prices have come down rapidly, production utilization is down at these levels, steel mills have almost in unison announced price hikes. So we've now got Nucor, US Steel, Stelco, pretty much all of them at this point have announced a $60 per ton price increase. I believe it's effective immediately. So that in effect puts the spot price for hot roll somewhere around $700 per ton. Is that an effort to slow the bleeding, or is that an effort to say we actually think the market is going to improve? I don't have the answer to that, but that appears to be their goal. Is they're saying we're not making as much money as what we wanted to. We've brought down our production to a level where we think we've balanced supply demand conditions, and thus we're going to announce a price increase on carbon sheet. We've talked about this chart, but I don't think we've shown it in chart form thus far. Many of you may have seen this before, but ultimately this is just looking at the historical spread between hot roll coil and cold roll coil. Cold roll coil is really just taking hot roll coil, running it back through the rolling machines, and giving it a better surface quality. It typically does come at a premium, but generally that premium is not quite as historically that premium is not quite as large as what we've seen over the last couple of years. The long-term average, I would say, is somewhere closer to about 100 to 150. We have recently, in prior, the last year or two, seen this spread go all the way up to $650. Fast forward to where we are today, things are beginning to normalize. Like many markets, things are beginning to normalize, and we've quickly seen the cold rolled to hot roll spread come back down close to $250. I don't see really any reason why this trend wouldn't continue, and we continue to push back into more normalized ranges, like many other indices and markets that we watch. So again, I would expect this trend to probably continue, and we continue to see this spread moving back into more normalized. I'm not saying we go all the way back to 100 to 150, but something back down to earth seems to make some sense here within this market. And then lastly, on the carbon side, I'll throw myself under the bus and say I've been wrong here. And again, if you're early, you're wrong. If you're wrong, you're early. This is showing the plate price relative to the hot roll coil price. And we're back into a situation by function of plate prices just kind of staying where they were and hot roll prices continue to drop, that the spread is back to almost $1,000 per ton, which is just a staggering spread when you consider the idea that really, for the most part, the production process of making plate is for the most part the same. That being said, I'm not going to take a victory lap. I've already thrown myself under the bus, but it is worth noting that just this week, at least one steel mill here in North America did announce a price decrease on plate. And that price decrease is $140 per ton. So, I would come back to this idea that it's not common that steel mills announce price decreases. They're very active and very, very open to announcing price increases. It's not often that they come out and say, we need to drop prices. I'm not trying to be too cynical here, but that would suggest to me that they're seeing things softening up fairly quickly in the face of new production capacity coming online from Brandenburg and other places. So even though we aren't seeing it yet, I would expect this trend to very quickly correct. And what I mean by correct is I would expect the spread between the two markets to converge. Whether that's a function of hot roll coming up a bit, plate coming down a bit, or the combination of the two, I think this spread is going to rapidly tighten up on us.
So Nick, earlier this year, we had Brian Crane on who addressed this very topic, right? And what he said is some of those leading factors are fewer plate producing mills, right? But then very specific demand, we can call it, like from things like the infrastructure bill coming online, things like that. Could these decreases, or like you said, like maybe an anticipation of a softening, speak anything to maybe not being as optimistic about that infrastructure work coming down the pike?
Yeah, I mean, it could be a situation where even though the infrastructure work is continuing to move on, other consumers of plate are weakening. So it doesn't have to mean that infrastructure itself is falling short. It could mean that it's another tangential industry that's just not holding up its end of the bargain. I can tell you, based on the noise outside my condo, there's still plenty of infrastructure going on within cities. But yeah, I do think that there's a realization that the market is slowing, and this type of pricing and this type of price premium over the carbon sheet products really probably doesn't make sense, and doesn't hold really much of a fundamental argument if things soften up.
It's certainly been an interesting phenomenon that we've.
It has been, and you brought up a really good point, which is I probably shouldn't throw myself under the bus. I should probably throw Brian Crane under.
Exactly. Yes.
So I appreciate that. Last but not least, I want to talk about nickel, and nickel's been a very curious one, and unfortunately a little bit of a broken one in terms of its market conditions over the last 9 to 12 months. You can see it somewhat here within this chart, although it's absolutely dwarfed by what happened back in March. But we, at least from my perspective, saw another short squeeze in the nickel market. In about 2 weeks, from late October to mid-November, we saw nickel prices jump 43%. Now, did anything fundamental change that would suggest the prices should go up 43%? No. There were some rumors that there was a fire or an explosion at a small nickel facility in New Caledonia, but does that warrant a 43% move in nickel when you've got plenty of class 2 nickel pig iron, nickel matte, things like that? I would say no. But what you do have is a scenario whereby a large amount of the trading community and those who participate in the nickel market have basically left. So whether that's a bank, whether that's a market maker, or hedge funds, consumers, whatever it is, 34% of trading volume has basically left the market, said we're not going to touch this product, all because of that nickel short squeeze that happened back in March. And when traders leave markets, it tends to cause larger gaps in buyers and sellers. It tends to allow a little bit more gamesmanship, and it just allows fewer players to kind of push things around. And I would say that's kind of what we're seeing. I know that might sound a little conspiratorial, but you can see it pretty evidently here. A large percentage of the market has left, and they have not come back yet. Will they come back? Maybe they will, and they'll add more liquidity, and you'll be able to buy and sell positions with more ease. But right now, unfortunately, the smallest headlines and the smallest bit of momentum can cause people to panic a bit. And like, for instance, from what I understand, when this squeeze happened, that happened back in early November, from what I understand, it all occurred based on about 2,000 contracts in nickel, which is maybe, I'm just doing quick math in my head, might be $20 to $30 million worth of nickel, that's a lot of nickel, but $20 to $30 million worth of nickel on a global basis really isn't that big of a trade. But from what I understand, it was that type of size that moved the market by 45%, which impacts billions and billions of dollars of physical metal transactions. That shouldn't typically happen in a normal functioning market. So it's something we have to deal with. It's something we're going to get through. I tend to think clear heads will prevail, and the good news is short squeezes tend to be short-lived. Maybe that's part of their name, but one anecdote that I found very interesting earlier this week, back in the short squeeze in March, I think we had talked about the idea that there were very, very large margin calls. The margin call basically being that if somebody was short, or in other words, betting on the market to go down, when the market goes up and up and up, they've obviously got losses on their financial position. It was estimated back then, and I remember talking about this on A Cup of Joe, it was estimated that those losses were somewhere around $10 to $15 billion, billion with a B, and that those numbers were on the brink of bringing the London Metal Exchange to its knees, or perhaps worse, bringing some of these banks to their knees in a way. And that was why they shut down the market, canceled trading, canceled a bunch of the contracts. Well, fast forward to this week, I saw one headline. I haven't seen it corroborated too many other places, but I saw a headline suggesting that the London Metal Exchange came out and said that those margin calls were actually $20 billion. So even larger than what we had speculated. And I think the vast majority of that was with one entity who was short the market. So $20 billion, I don't know about you, but that's a lot of money to come up with in a fairly short fashion. And that explains why things got so turbulent. And that explains why so many have left the market and said, I don't want to play here anymore. This is scary. Again, I do think clear heads prevail. I do think that this will sort itself out, but it's going to take some time. And the market's definitely got its bumps and bruises right now. And then last but not least, LME nickel. I know we talked about this last month, but I just want to reiterate the idea that when we look at nickel being all forms of nickel, class 1 and class 2 and various secondary forms of nickel, there is a lot of nickel out in the world. So the market is well supplied to make stainless steel. We're not going to run out of nickel to make stainless steel or even electric vehicle batteries in the next couple of years. The issue, what you've got is the LME is where class 1 nickel is traded, which admittedly is a fairly tight market. But class 2 nickel, as you can see over here on the right-hand side, trades at a very large discount to class 1, which is suggesting that nickel on the whole is actually fairly well supplied. And for that reason, I think we'll see clear heads prevail, markets to kind of stabilize a bit, and hopefully these short squeezes to be a thing of the past as we roll through 2023. With that, that is what we've got for Cup of Joe 2022.
Great stuff. Nick, I have a question. We speaking to 2022, the guests you've had on, we had Jeff Penns on, say about March, April, right? We talked about the import market, the containers, and the phenomena he brought us through was this shortage of containers. I read a few weeks ago, now we have a surplus of containers. And I'm wondering, does that speak more to, like, could it be a sign that, just yet another sign of things slowing down, or could it be back to that chart you were showing where consumer demand's a little bit down, so things aren't I guess, long or the short of it, is that just a little anecdote, or could that just be is that a sign of something bigger? No,
it's real. I think it's a sign of a couple things in combination with one another, though. Certainly, without a doubt, it is a function of supply chain bottlenecks normalizing. I would say it's for sure a sign of that. Things that were extremely hard to get are becoming much easier to get, whether it's a container, whether it's food, whether it's whatever. Secondarily, or maybe tangentially off of that, one of the reasons why things might be getting easier to get is because we are seeing things slow down in the Western economy. So the demand side of the equation, needing things, is also diminishing a bit. So I would say those two are playing hand in hand. I think there's a third element, which is, and we've talked about it in prior Cup of Joes, maybe 6 months ago, this idea of nearshoring or friendshoring, bringing things on a more localized basis, or I think what we call durable supply chains relative to efficient supply chains. Mm-hmm. Efficient supply chains being go wherever it's cheapest. Durable supply chains being go where you are most confident you can get it, whether things get really bad or whether things are normal. And I think that's also a phenomenon that's probably taking place, because if we take China as an example, and I don't mean to pick on China exactly, but as they do these zero COVID lockdown, open up, lockdown, open up, it becomes really hard to predict what they're going to do. And if you're trying to plan a supply chain around that and make a product and you've got long lead times, it probably gets fairly frustrating if you're trying to bring product in from there and all of a sudden they lock down and you can't get it for another year. So I do think that there's a function of that too that's taking place. It may not be immediate, that might be slow. Maybe I'm making this up, but I think that that's a piece of it too.
Yeah, very interesting. Yeah. We have a few questions for the audience, but before we got to that, I wanted to give us the results of the poll. Remember, we asked, knowing this macroeconomic update, what are your thoughts for 2023? 6% only were very confident, 64% somewhat confident, and 30% are not confident into business conditions for 2023. So interesting, and we'll see how it really plays out into the year ahead.
Yeah, and I think just to comment on that,
Thank
because I'm actually glad that that's the stance. I would say if I were to summarize it from my own personal stance sitting here as risk manager of Ryerson, I would say that I still do believe that manufacturing on a relative basis is going to hold up better than most other industries, particularly manufacturing in the United States is going to hold up better than most other industries, particularly tech and things like that. If we hit a slowdown, those are the spaces that are going to get hit relatively much harder.
Mm-hmm.
So as we look at 2023, if we go into a recession, does that mean people aren't going to buy farm equipment? No, but they're going to buy it less or slightly cheaper, maybe. So I don't think we should be considering the idea of the sky is falling, but I will say in the last couple of months, looking at manufacturing data, if I was to skew it one way, I would err on the side of cautious versus highly optimistic, mainly because you have a central bank at the Federal Reserve that is basically telling you they want to slow down the market. And if they don't get their way, they'll continue to try and get their way. So I would say cautiously optimistic is probably where I'd land as well.
Yeah, absolutely. I want to squeeze in a few of these questions here. There's a really interesting one here. I'd love to hear your thoughts. And I'm going to say this verbatim because I want to make sure I get it right. We're hearing industry folks talk about the relevance of the Midwest for setting prices for scrap and steel now that the Southwest is becoming a major force. Do you see this happening in manufacturing as well?
Yeah, I would say so. Yeah, I mean, there's certainly regions of the country that take advantage of certain elements of what states can offer, whether that's power contracts, whether that's tax advantages. And those regions tend to be where, manufacturing facilities go, and whether they're new ones or existing ones that move to a new location. Mm-hmm. But yeah, it's interesting when you look at scrap data for the last couple months, we've seen some interesting phenomenons whereby scrap in the Midwest, take Chicago as the proxy, will decline by 20 or 30 bucks. But then you look down at a different region, Arkansas, Tennessee, Alabama, and they are stable. So we are seeing it within the pricing data where certain regions of the economy from a scrap standpoint appear to be holding up incrementally better. And I don't know, maybe I literally just thought of this just now. Maybe that partially explains why we're seeing the Chicago PMI get hammered so bad. That could be related to a phenomenon of the Midwest relative to other parts of the manufacturing world is a little squishier.
Yep. Yeah. No, good thought there. Any thoughts on the rail strike? Anything happening?
I don't want to speculate too much. I mean, the commentary that I saw earlier today, and this might sound political, don't mean it to be, but from what I understand, Congress is very close to, if not already, coming to a conclusion that will prevent rail strikes from occurring legally. I know that's a weird way to say it, but it sounds like they've basically changed the law that makes it so that, I don't know whether it's collective bargaining or how it works exactly. I'm not an expert in this field. Let me caveat that. Mm-hmm. But there is still that open notion of, well, what about illegally? If a group of rail workers wants to strike, they can strike whether or not Congress wants them to. I know Eddie spoke on this in I think it was an MSCI event or a steel market update presentation that he gave. Nobody in the country wants to see a rail strike occur. It's a pretty important thing for our infrastructure, for our economy. I tend to agree with Eddie. There will be a solution. Maybe there are some concessions that occur, wages go up, hours decline, something like that, but it'll get fixed. It will get fixed.
I just got a note here that they just passed the bill that prevents the rail strike as of 27 minutes ago. So as we're talking here, they just.
This is Cup of Joe coming to you live.
Yes, thank you. Thank you for that update. So we're locked in on commodities. Thank you. Real quick, is the LME going to survive this nickel squeeze? I know you talked. That's the question. Do you think that does anything to the future of the LME?
I don't think they disappear. I think they've lost a lot of credibility. There are a lot of hedge funds that are very upset with them and suing them for large amounts of money that they believe they're owed. And I would say they're probably right. But do they need to tweak the contract potentially? Maybe. As we evolve in the world of nickel more towards nickel pig iron, nickel matte as being a more predominantly used product in the supply chains, maybe the contract needs to evolve as well. I don't know if that's moving to a scrap contract or moving to a nickel pig iron contract, but I think that that's the most logical conclusion because, you know, the other aspect you've got, and again, not to get too political or geopolitical or anything, a lot of that nickel is Russian. A lot of the nickel that sits in the London Metal Exchange is Russian material. That creates a little bit of a headache as well. And, you know, I don't have all the right answers on what it should look like, but I think it's going to be an evolution over the next couple of years, probably.
Yep. Right. And to be clear, that rail strike bill, it's temporary. It's headed to the president's desk. So
Okay.
keep it in the real-time news here. So, and a last question. This came right away. Were those kitchen scissors that were used on your hair? In the beginning?
Yeah, they absolutely were. I think they might even had a little bit of food on them. So I apologize if I had
Got it.
all presentation.
Well, I know we're running a little bit over here. On behalf of Nick, all of our guests, we mentioned many of them throughout, but we've had a lot of guests this year, and we thank all of you for joining us. We're definitely going to do it into 2023, as we mentioned, a big part of Engage, which will be in January. We're still going to have a January Cup of Joe. So right after your holiday, you take down the New Year's banners. I think it's the 3rd or the 4th. We're going to be having a Cup of Joe the first week of January. And then, so I'm going to kick it over to you, Nick, for a closing thought, but thank you, everybody. Happy holidays, and you know, hit us up for those 10 chart Tuesdays. I think that's a great thing in between Cup of Joes, as well as we do a monthly market report that comes out too. So make sure you're on the subscribe list to get that as well. Over to you, Nick.
Yeah, on the business side of things, I would just say, kind of harkening on what Mike had said, which is, we've got no shortage of data. We've got no shortage of information that we can get out to you. You know, obviously in Cup of Joe, we try and give our spin on it, give our take on it, which I hope is helpful. But to the extent you think we need to hit on something else, let us know. Or if you want more information, we've got it. 10 Chart Tuesday, what Mike's working on within the marketing team, it's great stuff. So keep hounding us for more information, because we want to provide it. We want to make the experience as good as possible. It's December. I hope everyone has a great holiday. Stay safe, have fun with the family. And last but not least, as Matthew McConaughey said, it's not time to escape. It's time to engage. And we look forward to enjoying Engage with everybody in mid-January with all of you. But happy holidays, and we'll talk to you in 2023.
All right. Take it easy, everyone.